Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Medfaber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got an awesome show today. Our guest is Jim Masturzo. Jim is the CIO of multi-asset strategies at Research Affiliates. We've probably had more alums on from this company than any. He's responsible for the firm's tactical asset allocation, cross-asset portfolios. He's also the co-portfolio manager on the PIMCO All Asset, All Authority funds. We're going to talk about asset allocation today, Jim's process, what he sees in markets. What's going on, Jim? Welcome to the show.
Hey, Matt. Good to see you.
All right, I got a tough trivia question for you to start with. I've always wondered, I don't know if you know the answer to this, 60-40 portfolio, which has been a pretty hard portfolio to beat for a long time now. You have any idea where that came from? What's the origins of it? Is it sort of weird? Like, I'd spent a lot of time looking around. I'm like, who came up with this actual, like, why wasn't it 50-50? That seems so much more simple. You got any idea?
Well, you stumped me right out of the gate. I actually don't know the history of it. We spend, I think, a lot more time in our world today, and you as well and others, talking about the death of the 60-40, which it never dies, more than the origin story. So yeah, I have no idea actually where it came from.
We were doing an article recently talking about Yale, and, they only look once a year at these yearly portfolios. So the volatility is a little understated, but we were saying 60-40 portfolio since 2009 has a Sharpe ratio like above 1. And I was like, that would make most hedge funds blush. Historically, people that kind of expect that to continue forever, I think the average historically maybe 0.4 or something. I don't know, but double, triple, good times.
Asset allocation is dead for most people, right? They've bought their 60-40. Maybe they rebalance once a year, and at least hopefully they do that. But I know some people don't even do that. So that 60-40 no longer looks like 60-40. But yeah, you're kind of fat, dumb, and happy at 60-40. And if you're expecting that to go on, then why do you care about other asset classes? Why do you care about diversification, alpha opportunities? Take your double-digit returns.
You don't need to listen to us. Just click off now. Go enjoy your day. But, you do mention actually something that was quite insightful. If you start with a 60-40, eventually you have like a 90-10. And especially recently, because bonds have really struggled this cycle. We put up a fun chart on bond after-tax performance recently on Twitter. But eventually, because of just the volatility and the outsized compound returns, you end up, so maybe you get a rebalance every few years. But we're going to spend this whole time talking about allocation and strategies. We've featured many times over the years y'all's interactive module on the website, which is like, I think it's hit an anniversary, right? Are we at 10 years?
It's 10 years. We launched it in the fall of 2014. When I started at Research Affiliates almost 12 years ago, the first thing I did was really look at our capital market expectations and kind of review all those models, clean them up a little bit, broaden them out. And then that kind of led to someone saying, hey, why don't we build a website and actually put these out there in a way that's a little more interactive than what a lot of other firms do, where, you kind of get the PDF download and you can read the numbers once a year. So we can update these all the time. We do it monthly. They don't change a lot, but sometimes they do. Things do happen. It also just allows things like anybody who wants to go in and build a portfolio of using expected returns and all those things. So it's been really cool. We get a lot of feedback from users. Last time I checked, and these numbers are a little bit old, but we had about 100,000 hits a month. I think it's well north of that now. So really didn't know what it was going to be. It was more like, hey, let's build a website and see what happens. And that kind of took off.
Well, it's really great, listeners. This is interactive.researchaffiliates.com. We'll put the link in the show notes. There's all sorts of cool stuff on there. We talked about this before on the show, but it's got everything from CAPE ratios for all the countries on there. And not only that, but going back in time. So you can look at, was the world going crazy in 2007? Just how high did China's CAPE ratio get back then? What is it now? On and on. It's really fun. It's also got all sorts of things on expected returns, which they detail in some of their studies, but also bond spreads, GDP growth. Anyway, it's really well done. It's a little bit of a rabbit hole, I'm going to warn you. But we'll talk about a few things here now to kind of as jumping off points that are featured there so you guys can go do your homework. Why don't we just start with thinking about where we stand today? Everyone, the starting point, of course, is U.S. stocks, S&P, which has been on a historic run the past 15 years, really exceptional, a 10-bagger, 15% per year-ish since bottom in 2009. But you guys, I'm looking at your CAPE ratio chart, looking at some of these valuations. You starting to get worried? How you guys feeling?
Before I answer that question, I will also point out maybe the greatest feature of our Asset Allocation Interactive, which you did mention. It's free. We don't charge anyone to use it. So I encourage everyone to at least take a look. Look, CAPE ratios have been elevated in the US for quite some time. So sometimes I think we sound like a broken record, and there's always the pushback of who cares if you run the CAPE ratio back to the 1800s, and does that even matter anymore? I just do a simple thing. I look at it and say, we can all disagree about what's the fair value of the CAPE. Right now, it's 36, 37, something like that. I look at it from 1995 forward. So take the last, 30 years, call that the internet age. Technology was going to change everything. Technology is the reason we can trade at higher multiples. So if we just take the average over the last 30 years, that average is about 28. And so if we look at 36, 37 relative to 28, you're talking about 20, 25% give. Something has to give. Either prices have to give or 10-year earnings have to catch up. Well, 10-year earnings move relatively slowly. I mean, it's obviously the average of the 10 years. So at some point, we just feel like this breaking point is coming. There seems to be a fragility in markets right now. I mean, we got a story, obviously, a week or two ago on DeepSeek, and all of a sudden everyone freaked out for a day and markets tumbled. And yeah, they rebounded. Everybody kind of, caught their breath a little bit. But it just feels like this fragility is coming. And if we build on a few of these news stories, build on the political climate, it's not unfathomable to see us kind of revert back to somewhere in the high 20s. And again, trading at a multiple of 28, that's still double what you're going to see in other markets. So it's not like 28 is cheap. The long-term average of CAPE is more like 17. So we're still talking about meaningfully above that.
Let me give some listeners some fun perspective from the tool. It's not that long ago, March 2009, US is low teens. And so that valuation metric has tripled since then, which has been an amazing tailwind. But right before the GFC, both China and India were trading at around 50. And here we are today, where China is back down to almost single digits. But India, it's really interesting. India is back up to 35. So you've seen this really interesting China-India divergence, which for the longest time, you look at their CAPE ratios, they're like twins. And here you've had a massive divergence, which I find to be really interesting.
Yeah, I mean, we used to talk about the BRICS as kind of this monolithic, everything is the same. They're going to grow at these huge ratios, kind of all in lockstep with each other. We know what happened to Russia, so we take that off the table. South Africa, obviously, and Brazil to some extent, kind of their own animals. But you're right. The idea that it was China and India from an offshoring and a manufacturing perspective, whether it be services or manufacturing, but they were going to continue to grow, and they've had this massive divergence. Some of that, I think, is due to demographics. Demographic profiles in India relative to China are very, very different. Also, just the adoption of technology. In some cases, the idea that when you're not replacing technology, when you're just rolling out new technology, mobile phones being a great example, we're not replacing landlines and things. That obviously takes a lot longer to do. You can have this technology revolution that happens, very, very quickly with a workforce that's pretty highly educated, strong education system, those sorts of things. So, and there's just been this focus on India by so many people. And we were talking about X earlier, and you can go on there and read all of the great investment stories about India. It seems to be baked into the cake now. And so at some point you say, okay, let me look across some of these other countries and that just no one is paying attention to. If we talk about green energy, we talk about mining and minerals. Well, there's a lot of mining and minerals and deposits in South America that are going to have to come to market if the green energy goals, which again, I know in the current political climate, we're not talking about green energy anymore, but it's not going away completely. So I think there's a lot of opportunities in South America, which is not investment advice for anyone to go and put 50% of their portfolio into, South American equities. But it's an area to keep an eye on.
And the fun part, as you scroll through some of these CAPE ratios and other ideas, you find that most countries are totally reasonably priced in the teens somewhere. Again, you have some that are single digits, and usually something has to be going pretty poorly for these to get to the single digits. Usually the market's down like 50, 80% or something. So the P and the PE has gone down a lot. But almost everything is reasonably priced with the exception of a few outliers like the US. But the good news is that most of the world is reasonable. And so one of the things as we think about this, you've just had this drumbeat, US just creaming everything. How do you think about that?
At some point, you start to sound a little bit like a broken record, and we get that from clients because we and many others that look at valuations and look at fundamentals would say, well, the US has been overvalued for quite some time. And what ends up happening, as we know in bull markets, is they kind of trudge up. You'll have these little pullbacks, but they trudge up for a long, long time. And then when they fall, they revert very quickly. So as I was talking earlier about, just feels like more fragility now. And that's something we've been talking about with clients. One of the pushbacks we get with respect to our asset allocation interactive site or our expected returns is, well, you kind of missed it with the US. You said US was going to return, call it 3% over the next 10 years, and we got double digits. Who cares about capital market expectations, fundamentals? We get that a lot. And so with the 10-year anniversary of the site, I actually wrote a piece that got published a few weeks ago. And I said, well, let's just look at what we said were expected returns in, I think it was June of 2014 relative to the next 10 years. So through June of 2024, let's just compare. How did we do? And there's a bunch of different studies in there, but the one that I think is interesting is we just took 18 assets. So the 18 assets, a little bit more broad than most investors have, but wanted to be inclusive. So we took 18 kind of high level assets, ranked them 1 to 18 based on our expectation. The highest expectation being 1, that was emerging markets, the lowest being number 18. And then we looked at the subsequent 10-year returns and ranked them 1 to 18 again, and then just lined them up. And what we saw is, by and large, things lined up pretty well, with the exception of 2 things. US large, stocks ended up being the highest returning asset of the 18. We had them at like number 9. We thought emerging markets would be the best returning asset. Turned out they were number 6. So it's not like it was 1 and 18. They were still, by and large, kind of in the middle there. But everything else in this middle section here, you're off by 1 or 2 ranks. And the reason I look at ranks is that if you get the rank order of assets right, your portfolio is, to the first approximation, going to be fine. You don't have to get the exact number of the return exactly correct for everything. We talk a lot about in our stuff, biases and how we try to take biases out of our models. And as long as you do that, your portfolio will, just getting the rank order right will give you the right portfolio. So there's a lot of still value in these expected returns. And to the extent that most investors in the US already have a US equity allocation, we always encourage everyone to say, look, fine, if you don't believe how we think about US equities, you don't believe in CAPE ratios for US equities, AI is going to revolutionize everything. We're all going to have our own personal robots in the next 5 years that are going to do everything for us. If you believe all that, that's fine. Just use it for everything else. You still got to think about how to diversify your portfolio. You should still think about these other assets, and capital market expectations are a good way to do that.
Even if we do all have our own robots, the DeepSeek, I think, is an interesting wake-up call for, I think, American investors. And it's less that they magically could replicate OpenAI with $5 million. That story seems to have fallen by the wayside or largely debunked. But it's also just that, why would you assume that all the great discoveries and developments are only going to happen in the US? To me, that's the bigger wake-up call. There's a lot more people in the rest of the world than in the US, and a lot of motivated countries, companies, individuals. And if we learn anything about AI, is that it can iterate and make exponential gains pretty quick. That to me is interesting. And even not just AI, but looking at things like drug development, obviously Ozempic and others, Novo getting in on those sort of progress. Anyway, but the good news is, all right, listeners, if we're looking at the rank today, we can pull up the chart and guess who's number 1? I see emerging markets value hanging out. Is that going to be the leading horse this time around? What do we think?
What's interesting when we look at emerging markets, relative to, say the US or developed markets, you see better dividend yields, you see higher earnings per share growth, you see a little bit of tailwind from, currency returns. Emerging markets unto themselves are not collectively now, and India is part of this. You talked about the overvaluation in India. Valuations are not the big tailwind as they have been at certain times in the past. They actually look relatively fair valued, and at fair value, you're still getting a really nice return relative to markets that are, severely overvalued. If you want to pay 37 multiple for the US, great, understand, but you can pay, as you talked about earlier, you're talking about mid-teens, which is not to say that every country should trade at the same multiple. There's different risk profiles and things like that. But still, you can pay $15 for a dollar of earnings, or you can pay 37. The choice is kind of yours. But emerging market value has that double tailwind of emerging markets being really well positioned. And then obviously value relative to growth, which is, again, we talk about as a US story, but is really a global story where value companies have just been unloved for so long because of the excitement around the Mag 7 and then how that bleeds into corollaries in other countries, the Alibabas and the Tencents and all that sort of thing that we don't talk about as much today, but 2 years ago were everywhere.
Yeah. And listeners can probably guess what the general flow of best to worst is, but worst coming in last at a negative expected real return. Am I reading this right? US large growth, minus 0.6%. Talk to us about that. That seems to be the other side of the coin of, and by the way, with emerging markets value, also up there is just developed ex-US value and basically anything, anything ex-US.
Everything
But
ex-US. That's right.
US large, you guys are going hard in the paint, not looking so good. Talk to me about it.
Yeah, we've been talking about US large being kind of where it is today for a while. The dynamics haven't changed much, except things have gotten a little more expensive. And that's been driven by the growth stocks, and in particular, as we know, the mega cap growth stocks, which have gotten even more outlandish relative to their fundamentals. Not to belabor the point on DeepSeek, but we get one news story and all of a sudden, the NASDAQ drops 3% because, well, wait a minute. Are the moats as big as we thought they were? Do we need to sell as many NVIDIA chips as we thought were going to be necessary? Is there more efficient ways to do some of these models? Does everyone need, or will everyone need the next best AI model? Or for most of our general tasks, they're much simpler models that will do the job for what most of us are doing on a day-to-day basis. Tunnel vision sometimes on the next best thing and how many parameters are in this model versus that model. When you step back and you say, do you really need all of this? When I go buy a new television, which doesn't happen very often, but when I buy a new television, I need the best of the best to watch basketball. For the stuff I'm watching, it really doesn't matter. It all looks good enough.
The cool part of y'all's module is that when you click through something like US large, it says, here's the expected returns, garbage. But it's like, this is what comes from yield. This is what we expect it to come from growth. And then this is what we expect from valuation change. And then here's how we get to the final. But the cool part, and this is the beauty of being a quant, I love this, is it has a cumulative probability of return. So yes, we expect low to no returns for US large growth, but there's a chance it still does 6% a year. There's a chance it does -4 a year. And then you give a probability. What's the chance it's probably going to hit this 5% historical real return? Not surprisingly, for US large growth, that number is small. But it's cool to break that down because this goes back to Bogle in the 90s, was talking about the big return drivers and breaking them out for the S&P and other asset classes. But it's fun to click through some of these and kind of see, hey, well, you got a higher starting yield here. Or, hey, maybe we're not expecting a lot of growth, but we are expecting some valuation change or mean reversion. So it's pretty fun to click through what some of the drivers may be.
You talked about when we talk to clients, and this is a part that we kind of emphasize with them. If they say, look, we don't believe your number, and you say, okay, great. Well, here are the components of which part don't you believe in? And when you now have to drill down and say, not just say, well, here's the top number. I think the number is going to be 5% or 10% or 8%. You're like, well, why? Which of these subcomponents do you not agree with that you want to change? And you can make rational people can make rational arguments for why certain components can be different numbers, but that's a much more fruitful conversation than I think the number should be 8. And you're like, why? Well, because that's what it's been.
Yeah, I like it. So you alluded to value, and I mean, I feel like this is a topic we discuss a lot, but Rob and others y'all work with talk about factors that may look better at some times than others. What does value look like today as far as historically? And you can take this any way, just within the US, abroad, everywhere. Is this something, or are we banging the table, smashing by? Are we cautiously optimistic? How are we feeling about some of these spreads and factors?
It's the same sort of thing where we've just seen this divergence between growth and value that it's episodic. So at times the spread between the two will come together and then it will widen out. Value has gotten really, really cheap. So the spread in fundamentals widened out, started to come back together in the early 2020s, and then started to widen out again as we've seen mega cap growth sort of take the forefront. And as we think about things like concentration in the market, we know the market is more concentrated now than it's, I think, in history ever been, such that various indices have had to change their rules because they've just had too much concentration in 5, 6, 7 names, depending on how you want to think about it. And so that trudging forward, carrying forward of those stocks, and just sort of everything else kind of being pretty much mundane, again, has widened this out to the point of where we look at value again is, look, at some point, people have to wake up or should wake up and say, there's a lot of cheap companies out there that aren't cheap because they're bad. They're just cheap because they're boring. They're cheap because they're not in the news. They're cheap because of whatever. And so instead of chasing the next big thing, diversify your portfolio back into some of these unloved names. So that's something we talk about a lot. I think sometimes people listen to us and maybe it's our messaging. We're not telling anyone they shouldn't own growth. We're not telling anyone they should never own Amazon and Apple and all of those. Of course, you want some of those in your portfolio, unless you're really somebody who's comfortable with a lot of tracking error. But you shouldn't just have those in your portfolio. You should rebalance those positions down before they eat the rest of the portfolio.
I don't know what the most controversial asset projection would be in this. I feel like a lot of the people will be like, yeah, I get the large growth. Everyone's talked about it. We all know it's expensive. We're just kind of waiting for the party to end. But I made this joke on Twitter where every year-end outlook had expectations, and there was always one magical one to the far right, which was private equity, which is like everything else is muted. And even the ones that are like, man, we expect US stocks, S&P to do like 5 instead of 10. But private equity, we still expect to do 12 to 15. Now, these are always the companies that offer private equity and LBO opportunities. Y'all's isn't saying 10 to 15. It's not even saying 10, because I feel like everyone's gone to private equity as the savior in private credit at this point. They just magically, that's what's going to save my portfolio if the S&P stinks it up. You guys don't think so? Maybe talk a little bit about that.
You're right. Private equity and private credit and everyday vehicles get launched for how to allow retail investors to put more private equity, more bank loans, more private credit, more mezzanine, more whatever into their portfolios. And if we think about private equity, the way we think about it is private equity relative to public equity shouldn't be that different. The fundamentals that drive the economy drive the economy. You can argue about illiquidity premia and sort of things like that, okay, around the margins. But the idea that you would say you think public equities are 1% or whatever, 1% real, and private equity should be, 10x of that. Well, you're going to have to square that circle, because I don't understand the fundamentals that happen in the economy that somehow allow that to happen. Restructurings of companies that go private, really, you're going to take them from still a 10x over everything else. And then the more interesting part, I think, is the volatility. And many people on Twitter have arguments about the volatility of private equity. And I sort of laugh about that because, again, you're talking about levered equity. Like, forget the fact that you're only valuing it once a year, or you're valuing it based on your own external valuation firm and the number never moves. And so therefore there's no volatility in private equity, or it's 3, 4, 5%. And we see this with other folks who publish expectations. They'll have volatilities in the low to mid single digits. Well, it's levered equity. So if equity is at 15% and you lever that up 2x, well, I don't know how your volatility goes to 5.
I don't even know if it's a debate. I think it's actually everyone across the board understands that private equity is not a 4% vol strategy. I just think the people who are marketing it, it's a wink, wink, nod, nod. There's no question they know better. I've never met someone who's like, yeah, I actually believe this is 4% volatility. Maybe some of the salespeople who send me these emails, because I write back and I'm like, bro, you shouldn't send this to me. And two, this isn't a 4% vol. And then they try to actually say that it is. But I think everyone knows it. I just think it's such a good selling point for them when they talk to someone who doesn't know it. So maybe it's a financial advisor who just, everyone wants to believe. And so it's maybe that they can tell their clients, well, because we only look once a year, it's not that volatile. And so it's a weird setup. I think you're probably going to get regulators knocked down on that at some point. But as far as the pros, I don't know that anyone actually really believes. I think everyone knows. It's just like, what are they going to do about it?
I think you're right. But the frustrating part of it is that everyone who is close enough to private equity to understand private equity knows. But then they sell it to the advisors, the retail investors, put it in this fund or that fund. And then the story. So they still peddle this to the people that don't know. And so why don't you just be honest about, look, if it's not 4, if you want to argue it's 20, 25, 30, whatever you want to argue, fine. But let's have some intellectual honesty about what we're trying to do. And if your product is good, you should be able to market it at that vol and it should still be attractive. The fact that you're saying it's a 4 or 5 vol to your run-of-the-mill advisor kind of leads me to believe you don't really believe that your value proposition is there if you showed the real vol. So you're going to, tell the story. But I agree with you that everybody who thinks about it kind of already knows. They just, you're right, wink, wink, nod, nod. I won't say anything if you don't say anything. Well, on our website, we try to say something, not that we're experts in private equity or anything, but let's try to help people out to the extent possible.
We saw an interesting ETF launch. I'm not going to mention the name because I pick on this firm too much, but it's replicating PE and VC. And I actually like the underlying index, but to replicate in public markets what PE and VC are doing, the total nominal leverage that is using is 2.5 times. So let that sink in, listeners. So to get the return, exposure, risk, return, volatility, it's going the other direction, right? It's leveraging it, just, let's round and say 2 times. So it's not even a 17 vol. Now it's a 30 something or 40 vol, but just because you look once a year. So it's going to be really interesting to see how these track the returns. And then you can kind of like connect the dots in between the year, right? So we were modeling out, for example, we did this article recently about the Yale and average endowments going back to 1985 and said, well, look, if you look at the worst year for many of these, and it was 2009, they did minus 20 something percent. But intra-year, that was probably minus 50. It's double. So across every metric in it, because if you look at the ones that approximated it, they also had the worst year of minus 20 something, but intra-year was minus 50. And so that's a big difference. Like living through a 20% decline, whatever. People can handle that. 50 is a little different. As we saw in 2009, a lot of people couldn't take it anymore, sold it all, never to get back in.
If you can handle a minus 50, if you're an endowment and you understand your spending levels and you understand your horizon, which might be multiple lifetimes, depending on how you think about it, it's very different than someone trying to manage their retirement and they see a minus 50 and then they just freak out and have to sell, which is one of the issues I have with, I think, some of these vehicles that are trying to replicate some of these other asset classes. Look, 2x leverage, if you understand what 2x leverage means, fine, you can invest in that, no problems. What people don't understand is that, and maybe the best value you get out of private equity is the lockup. You can't sell when you freak out because you've contractually agreed to keep the money in. If you're selling an ETF or you're buying an ETF and you see these massive volatility that comes with 200, 250% exposure and you're not used to that, well, of course, you're going to sell. As soon as you go, oh crap, I got to get out before it goes to zero, you probably got out right at the bottom, which is usually what happens. So I just think people need to think more about their own risk appetites and what can they really handle. And unfortunately, because things like high cape ratios for public equities are out there and people understand that story, private equity can come in with, yeah, we all agree public equities are bad, but let me tell you our value proposition, which is different. And people say, oh, well, okay, that's 1%. You're telling me 10. Sure, I'll do that. So there's just a lot of risk there that's just unfortunate because I think, there's financial literacy, and I don't want to get on a soapbox about this, but financial literacy is not as high as it should be.
There's another giant asset class, maybe the world's biggest, I don't know, where you guys talk about, you got some charts, and now I'm talking about fixed income. And this has been a huge head scratcher for me. I don't know why it's not a huge head scratcher for everyone else, but looking at bonds, not just within the US, but around the world, but looking at sort of the spreads, I feel like people were talking about historical yield curve. Like that was a phrase people used. I don't know if they really did anything about it, but you guys got some fun charts, asset class valuations matter, where you're looking at not just yields, but spreads, for example, on corporates and high yield. And we're talking high yields, 5 percentile. And that 5 is not the good one. Talk to us a little bit about fixed income. What do you guys see? Opportunities, landmines?
Let's start with the spread because I think it is fascinating what you point out, and particularly with high yield, where spreads are 2% now. You talk about the fifth percentile, and not in the good way. Now, some of that I will say is due to high yield indices, high yield portfolios have actually improved their credit profile. So they've moved away from some of the lower credit ratings to some of the higher, and so that naturally will depress spreads, mainly because a lot of those lower credit rating companies looking for funding went to the private markets. So they've gotten out of issuing high yield debt. They go, I offer private credit and all that sort of stuff. So there's some avenue there. But when you're thinking about looking at treasuries, looking at a 10-year treasury at 4.5, and you say, well, I can take on a bunch of junk rated credit quality and only get 2%, you kind of say, why? I mean, at some point, you're actually better. We talked about leverage. You might be better off to think about getting your treasury access through derivatives, through bond futures, and just taking some leverage on that and probably do better off. Now, with fixed income in particular, as we think about treasuries or government bonds across the developed world, we had this amazing ride down for 30, 40 years where rates just fell and everyone kind of banked on the fact that next year rates will be lower than this year. There's some really fun charts. I know put a whole lot of stock into them where you can take, yields back to the dawn of time, literally to like BC times. And you see this long-term falling of rates. Again, it's more of kind of fun things to look at. I don't put a lot of stock in it, but at least for the last 30 years, we've seen this depression until we get to 2020, 2022, when the Fed and all the other central banks started to raise rates. And I think the belief was, great, we're going to raise rates. And then, yeah, but don't worry, it's only going to be a couple of years. We'll fight inflation and then we'll go back to zero. What we're seeing now, the Fed saying, look, we're kind of afraid about inflation. We're still a little worried. So we're not going back to zero anytime soon. We'll wait for the next recession. We want to have some room and when bad times do come. So we look at fixed income as being an opportunity again to actually earn a return. It's a nice asset class now. For so long, why did you own fixed income at 1% or 0.5%? What's the point? But at 4%, 4.5%, well, that's kind of a nice, interesting, low to no risk return. There's a lot of chatter out there about long rates and can the Treasury manage the long end of the curve? The short end, obviously, they can manage, very effectively. They're very good at that. They have control. But what happens on the long end? And we saw in Q4 of last year where long rates started to blow out. So there's definitely some volatility to be managed around that. And so as people think about their duration risk, our perspective is to stay more in the middle of the curve. 4 years, 5 years, 6 years, you're getting a little bit of a bump from cash rates now that the yield curve is upward sloping again, but you're not taking all the duration risk, as you move out too far. I personally think, I'm not saying this is good for the country or government economies in general, but at some point, as opposed to rates going to 6%, 6.5%. I've read people online talking about that. At some point, I think the Fed will step in and control the long end of the curve, as we saw in Japan, as we saw in Australia. Japan trying to walk that back now. It's a very difficult thing to do once you start doing it. So even though there's volatility at duration, my personal perspective is there's a limited downside because given interest expense, given the deficits, 6% interest rates would be very, very difficult for the country to manage.
You mentioned Japan, and I feel like Japan, it's become its meme where everyone talks about Japan. It's like Now Do Japan, where they talk about where valuations actually mattered. You had this massive bubble, and then stock returns were terrible for 3 decades. You had this weird situation where they had like no interest rates for a long time and negative-ish, and like it was always like this little island sitting out there, and yet it's still a top 3 world economy, stock market, on and on. And they've started to have interest rates coming up. Does Japan look pretty good now? Like, how should we think about it? Are we turning in Japan? China turning in Japan? How do you think about some of these outliers when trying to think about maybe they're not an outlier, maybe they're the average?
Japan is an interesting test case, but I think the story is, well, look, actually, Japan has huge debt to GDP ratios, and they just kind of let the currency fall, and that was okay. And now they're starting, after all this time, to raise interest rates and all those sorts of things. And all of a sudden, everything is going to be okay. And sometimes I wonder, well, yeah, of all the future paths that are out there, some of them are okay for a country, and many, some of them are bad. Do you want to go through that route if you don't have to? Like, if we just decided that because it worked for Japan, every other country can do the exact same thing, and therefore don't worry about debt, don't worry about deficits, don't worry about any of those sorts of things. We'll just do what Japan did. To me, it's still unclear that Japan doesn't at some point hit a wall and kind of fall off. The currency is still exceptionally weak. That's fine for a couple of years, but you start getting that to a decade, well, that starts to change things. So we see improvements, we see changes, and look, they kind of hold for a year or two, and we kind of say, "Hey, victory! Everybody, it's a mission accomplished." To go back to something from about 20 years ago now, I don't necessarily think that's the case. I think there's still a long road for Japan, and I think other developed markets will end up in that same place and may end up with far worse outcomes because the Japan path is not a foregone conclusion.
Looking at some of y'all's charts, there's something that stood out to me. I think if you were to ask most people, if you were to say, what's going on in the economy, looking at something like manufacturing and the PMIs, I think most people would be surprised to know the PMIs for many current countries are sub 50. What's going on? Is the world slowing down? Is it just the rest of the world? Is it just Europe? What's happening?
Yeah, you're right. I think many people don't focus on PMIs and what's happening, but you're right. They're all kind of sub 50, 50 being that kind of steady state number. And they fluctuate, as we can see in the charts. They do fluctuate, but they're all below. One of the things that I think is interesting is that unemployment to some extent masked a lot of the underlying issues with manufacturing and with the other things in the economy. And a lot of the unemployment, which unemployment has been rising, but a lot of the employment we saw was government, was public employment. And now, with where we are, at least in the US in particular, thinking about, well, now we need to reduce government. We want to shrink government. We want to undo a lot of the hiring that was done. Well, the private sector hasn't been keeping up with employment. So I think over the next couple of months, we could certainly see the employment trajectory change. And then things like PMIs, you start layering those together and saying, we're not manufacturing as much as we should or as we were. Unemployment issues. There's also some restatements of unemployment from last year. Hey, big surprise, things were overstated and they're reducing those numbers sometimes from positive employment to negative employment. And so, long way of saying these other things I think have been masking where the PMIs are in particular at 25th percentile or in some cases even lower. Again, that's on the bad side. That's the bad 25%, not the good 25%.
We got a fun, quick questions to ask as we're starting to kind of wind down here. We've kind of covered a lot of the world, but there's a few things we haven't mentioned today. You guys mentioned commodities was something 10 years ago you weren't super stoked on. Here we are today, gold, one of the commodities knocking on 3,000, may have already hit 3,000 by the time it's published, maybe back down 2,000. Who knows? Nobody knows. But it's hanging out at all-time highs. You can feel free to talk about gold. You can talk about crypto. You can talk about farmland, private credit, whatever you want. Any other assets that we haven't mentioned that you think are notable to discuss?
I am a believer in commodities. I think commodities have a place in everyone's portfolio, but I like to preface that by most commodity ETFs out there, which track your typical commodity long only commodity index, are garbage. Commodity indices, you can track them back to 2000. They don't really return anything. Commodities are an area where active management makes a lot of sense. Factor-based investments, we do a lot of work on thinking about commodity factors and putting those together. And when you're dealing with derivatives, which these commodity products are, no one's actually buying cows, they're buying futures or options on, livestock. You have two options. One, you can take leverage very easily, it's cheap, and you can short. So the idea of saying I'm going to buy commodities, but I'm going to limit myself to long only, no leverage, you're hamstringing yourself from the start. So as we think about what the world needs going forward from a food perspective, metals, you talked about, precious metals, and you talked about gold, but silver and platinum are also right there as well. And then, things like copper, nickel, lithium, all of the green energy stuff that everyone admits we don't have enough of to meet even close to the goals that are set out, from electric vehicle manufacturing and demand and needs to solar panels and all the other things. So I think commodities, for those that aren't paying attention to commodities or don't have them in your portfolio, I think it's something to pay attention to. And to me, much more interesting, not to mention diversifying to stocks and bonds relative to, private equity, private credit, all this other stuff that I think it's much more press headlines.
What's been your most memorable investment? You look back over your career, good, bad, in between?
It's funny because all you ever remember are the bad ones. Remember the things that didn't go well, not the things that did go well. We launched in our manager, we'll tell you a trade. We launched 6 months ago or so an alternative risk premium product internally that we're just trading with our own capital and things like that. So that's been a lot of fun. It's a global futures product. So just looking at a lot of the, not necessarily the individual trades, but looking at the underlying signals and how they react to various things going on has been really, really interesting and kind of eye-opening. And so, pretty exciting. I've been doing a lot of work in kind of in trend following and thinking about trend and how do you think about creating a trend following program? What are the trade-offs between, usually with trend following, it's a trade-off between, do you want high Sharpe ratio or do you want more positive skew? You can't get both. So different managers will make different decisions, but how do you think about that? What do we want in a product relative to, or in maybe this product relative to other products that we might have? You make different decisions. So those sorts of things I think are really interesting. As a quant, we get to really think about underlying drivers of, asset returns and those sorts of things. And that's what kind of gets me excited.
Well, Trend, you're speaking to my heart, man. That is an area we have loved for a long time. I think it's the premier diversifier to a traditional buy and hold portfolio. I don't know if anyone else agrees, but we're big fans. Where do people find your writing, what you're up to, the Asset Allocation Interactive? Where do they go? What's the best place to keep up with what y'all are doing?
Researchaffiliates.com is where everything is located. You can click through. There's a link there for tools, which will take you to the interactive site for those that didn't write down the direct link that you put out there. Trying to find more times to write. We do a little bit on LinkedIn. I'm not a huge social media poster. My mental health is much higher when I'm not, engaging in some of it, but that's an area that I probably need to change. So most of the ideas, either LinkedIn, feel free to connect, or through our website. And just to build on real quick on your idea, I completely agree with you on trend. I think stocks If you want economic growth in stocks, you want income and diversification with bonds, some sort of alpha generation. Long short commodities, I think, is a great example for alpha, and then some downside protection. And trends is a very straightforward way to get downside protection, get skew into your portfolio. So as I think about it, when I talk to our clients, I think about those four pillars. I started calling it the four horsemen, and then biblical references came up, which I didn't think about. I was thinking of other four horsemen. So
I love it.
Yeah.
Jim, thanks so much for joining us today.
Yeah, it was a lot of fun. I appreciate it.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.